Coming up on the show today, CDC Group targets $1 billion of African investment in 2021. African Development Bank, AFDB, seeks to empower women entrepreneurs in Africa. And executive of South Africa's Public Investment Corps accused of fund mismanagement. Hello and welcome to Business Incorporated. I'm Ini John Mekwa. We start with the markets. It's mixed sentiments on the African continent intraday. In Egypt, EGX 30 index was the highest at 0.79%. Nigeria followed with the NGX all-share index positive at 0.24%, while Kenya closed Monday's trading at 0.21%. South Africa's JSE was the only negative at intraday, down by over 1%. And in the Middle East, sentiments were also mixed at intraday. Saudi Arabia's index was the biggest gainer, adding almost 1%, and far behind, Dubai's index was up 0.36%. On the flip side, Qatari index declined 0.23%, while Abu Dhabi lost 0.14%. We move to Europe now, where markets dropped sharply today following a sell-off in U.S. tech stocks at the start of the week, and as global markets turned their focus on inflation data. Well, Chelsea Dulani is at Frankfurt and has some backup to the story, telling us the backstory to all of this. Hello, Chelsea. Good afternoon. Thank you so much for joining us once again this week. Well, how serious is this sell-off here, and how are traders taking it? And also, what's going on with the tech stocks?
Well, it has been a very dramatic start to the trading day here in Frankfurt. The DAX is down about 2.5%, and that's after we saw Asian stocks get hit really hard as well, some falling, some indices in Asia falling the most since March 2020, when the pandemic had really just begun. So this is a big correction for a lot of indexes. The big driver, of course, is inflation. We've seen inflation fears really come back to the forefront for investors. That's as commodity prices are really starting to soar. Everything from corn to ore, iron ore, and copper. All of these products are becoming much more expensive as demand starts to pick up. This pent-up demand as economies reopen. Of course, this is raising the question of whether central banks will have to step in and change their monetary policy. For tech stocks in particular, that would be quite negative. Tech stocks have benefited from this environment of low interest rates, of very easy monetary policy and stimulus coming from the world's major central banks. If that is taken back, it would be a major concern for investors.
Yeah, and European Central Bank member Isabel Schnabel predicts that German inflation will rise above 3% as the country reopens. Could this force the central bank to change its monetary policy?
Well, this is another big question on an investor's mind: is will the rising inflation we're seeing force central banks to raise interest rates? The ECB so far has indicated that they're not too worried about the rise in inflation. Isabel Schnabel, just the latest out today, making these comments, saying that this looks like a temporary rise in inflation. They're willing to look through it. They're not ready yet to change their monetary policy, to tighten interest rates, or to stop buying bonds. So they are trying to play down these fears, but markets clearly are not believing that at this point. There's a lot of money flowing into these bets that interest rates are about to rise. So I'd say that investors, are not quite convinced that these central bankers will be able to put off interest rate rises.
And airlines, including Germany's Lufthansa and Hong Kong's Cathay Pacific, are raising more cash as air travel remains depressed by the pandemic. Tell us more about that.
So airlines have already been through a big series of fundraising in the past year since the pandemic began and really devastated their businesses. We'd seen a wave of bailouts here in Europe. For example, Lufthansa received about 9 billion euros from the German government. Air France KLM also received billions. But now that the pandemic is stretching on, now that travel restrictions remain in place, many airlines are having to once again tap the markets. Lufthansa is reportedly looking to raise about 3 billion euros on the market. This has spooked investors a bit because Lufthansa already has taken on a lot of debt, but they're saying they want to repay some of this money that they received from the German government. Cathay Pacific also was in the market this week selling bonds as they also face a much longer recovery than initially expected. So for now, there does seem to be demand for these bonds. Investors are buying them, but it will, of course, raise concerns about the debt levels and what the prospect is for a recovery for these airlines.
Well, a long way from recovery, that's what we see. Thank you so much, Chelsea, for the updates, and enjoy the rest of your day. Well, we move over now to London, where Juliana Olayinka is standing by at our studios there to continue the conversation. I would say hello, Juliana. Good afternoon.
Good afternoon, Nene.
Yeah, so I know you discussed the markets with Chimi in the morning. Is the sell-off still on? What's the update on that and other data?
Yeah, well, it's been a pretty volatile 24 hours. I'll be repeating much of what you just discussed with Chelsea and Frankfurt. Investor sentiment is squarely focused on inflation. I think they got the signals overnight through China showing that inflation had risen 6.8% year on year. I believe this is one of the biggest yearly inflations rise in about 3 years. Tomorrow, everybody's looking at what the CPI data is going to be coming out of Washington and whether or not the Fed, as Chelsea was saying, will start tightening up its monetary policy, which has been loose because of the pandemic over the past couple of months. How is this affecting the FTSE? Well, pretty badly. It had triple-digit losses at the start of early trading, and it's still bleeding through the nose at intraday. The FTSE All-Share is down 2.25%. The FTSE 100 is down by 2.34%, and the FTSE 250 is also down by over 2%, 2.05%. In the currencies market, the British pound is up on the US dollar by 0.11%, down on the euro by 0.17%, and up on the Japanese yen at intraday by 0.02%.
And then supermarkets group Morrisons is smiling to the bank, and fuel sales contributed over 5%. Meanwhile, Heathrow lost 6.3 million passengers in April. Different strokes for different folks we see here.
Well, yeah, Morrisons, they are the fourth biggest supermarket here in the UK. Their shares are pretty much the only shares that are rising on the FTSE 250 today, not by much, but by 0.5%. And that's because they've delivered their trading update for the 14 weeks to the first week of May. And it's pretty positive, showing that sales have risen by 2.5%. Online sales have more than doubled if you compare it to this time last year. No surprises there, because a lot of people that used to buy in shops have been buying online during the pandemic, particularly at the beginning of this year, because we were, of course, still very much in a lockdown. COVID fears are not too far away for Morrisons, though. They had to spend £27 million during that period alone to cover staff costs, to put more security in stores to make sure people are wearing their face masks. But bosses are still selling a brighter mood. They do believe that when lockdown does begin to lift again, and we've got a further ease in on Monday, they suspect that a lot of people, especially families, will be buying more food because we'll be able to start hosting people at home. And we've got a couple of big events coming up, one being the Euro 2021. And of course, I believe there's a pretty popular Champions League final coming up very soon.
Wow, I can see you're excited about that. But in spite of that excitement, the British Retail Consortium is warning that store closures and job losses are still a threat to the retail sector. What's their reason for this?
Yeah, it's an interesting story because I think I was reporting on this show last month that non-food retail sales were up 24% in the month of April. Of course, this is all attributed to the 12th of April reopening of non-essential food stores. A lot of people going in, buying up lots of their summer items and snapping up some sales that were there since the winter. But the British Retail Consortium have asked the government not to take this data as evidence that there is a full rebound recovery in the sector. I believe about 500,000 retail staff are still on furlough. The furlough scheme is going to be winding down in September, and we know the bulk of the almost 1 million jobs that have been lost during the pandemic in Britain have come from the retail sector. I've got a statement here from Helen Dickerson. She's the BRC's chief exec. She says many fashion retailers have had an uptick in sales. However, this data is fragile. There's little competition for share of spending, while parts of hospitality, leisure and tourism remain restricted. So what she's basically saying is that even though, yes, a lot of people have been buying clothes, they haven't been doing things like going on holiday or spending money in hotels or bars or restaurants indoors, so that we have to be very careful and cautious, and the government must stick to their pledge of reducing business rates and trying to overhaul the high street to make it a lot more competitive again, because of course they've been suffering with online competition, Innie.
Yeah, talking about balancing expectations, I would say. Well, anyway, thank you so much, Juliana, and enjoy the rest of your day.
Thank you.
So we move on to Asia now, where most Asia-Pacific markets came under pressure today following a sell-off. Well, talking about the tech stocks that weighed down major on U.S. indexes overnight. Stocks in Taiwan led declines across the region, with the benchmark TAI ending the trading session 3.79% lower. Japanese stocks also recorded losses, with Nikkei 225 shedding 3.08% to close. And while the topics moved 2.37% lower, South Korea's Kospi ended 1.23% lower. In Australia, the ASX 200 inched down 1.06% ahead of the government's budget announcement on Tuesday evening. Hong Kong's Hang Seng Index fell 2% in late afternoon trade as Chinese tech stocks declined. Shares of food delivery giant plunged about 6% as authorities in Beijing continued to clamp down on internet firms, while tech giant Tencent fell 2.3%. Mainland China markets, however, eked out some gains towards the end of Tuesday's trading session. Shanghai Composite ended 0.4% higher, and the Shenzhen Composite inched up around 0.36% at the close of trade. In the U.S., futures for the tech-heavy Nasdaq 100 lost 1.3%. S&P 500 futures traded 0.8% lower, while those tied to the Dow fell around 195 points. Shares of big tech stocks were all in the red once again today. Facebook, Apple, and Amazon were all down more than 1.5% in pre-market trading. Tesla shares fell nearly 4% in pre-market trading as Reuters reported the electric car maker and bellwether growth play halted plans to expand its Shanghai plant into an export hub. Big tech got clobbered on Monday as investors exited stocks like Apple and Microsoft, dragging the Dow Jones Industrial Average and the S&P 500 off their record highs in the process. Both of those stocks lost at least 2% to start the week. Nasdaq Composite suffered the worst of the selling and fell 2.5%, finishing the day at a session low on Monday. Facebook lost more than 4%, while Amazon and Netflix both dropped over 3%. Alphabet dipped more than 2% after a downgrade by Citigroup. Well, we move on to the oil market now. Oil prices fell today as the prospect of the main U.S. East Coast gasoline pipeline remaining shut for the rest of this week led to some U.S. Gulf Coast refiners cutting their outputs, denting their appetite for crude. U.S. West Texas Intermediate crude futures fell 40 cents to $64.52 a barrel after gaining 2 cents yesterday. Brent crude futures dropped 45 cents, which is 0.7%, to $67.87 a barrel. Colonial Pipeline, which transports more than 2.5 million barrels per day of gasoline, diesel, and jet fuel, shut down its network on Friday after being hit by a cyber attack. Colonial said on yesterday that it aims to resume full operations by the end of this week. The benchmark U.S. gasoline futures contracts, which spiked after the outage, has now retreated to pre-Friday levels on the prospect of a restart. On Tuesday, the contract was down 0.6% at $2,121 a gallon. We'll take a short break now. We have more stories for you on the other side. Stay with us. You're welcome back. Well, Goldman Sachs analysts have called iron ore the new oil. This is after iron ore futures on China's Dalian exchange rose 10%, the daily trading limit on Monday, to a record high. The rally comes against the backdrop of buoyant commodity markets, beg your pardon. Well, Seyo Mediora, a research analyst with financial derivatives company, joins us to talk about this new oil. Hello, Seyi. Good afternoon.
Thank you.
Yeah, so the price of iron ore on the Singapore exchange is now at a record high of $226 per ton, and this is up from $155.84 at the start of the year, an increase of approximately 45%. What are the potential implications of this sharp increase in iron ore prices for top global producers like Australia, Brazil, and China?
Yes, so we know that we have actually observed some interesting gyrations in the iron ore markets recently and more lately yesterday. We know that the price increased by about 10% on the Singapore exchange as well as on the Dalian exchange yesterday, so about $226 per ton as of yesterday. To be honest, it's trading a lot more like a cryptocurrency than a base commodity at the moment. Also, we observed that earlier today, there was some pullback from the profits from the gains yesterday. And this was due to the fact that the Dalian exchange last night said that they were going to impose certain trading restrictions, increased margin requirements, and trading limits because of the sharp increase they experienced yesterday. Now, as for the implications, this increase in iron ore prices will be for net exporters like Australia and Brazil. Of course, this means that they are going to experience higher foreign earnings because of this increase in price. For China, however, who is a net importer of iron ore, it's going to be quite different for the fact that this will have an impact on input costs, which will subsequently pass on to inflation. And as a result, what we are likely to see will be monetary authorities employ or deploy monetary tools to curb inflation, and this might be earlier than the economy needs. So this might be an implication for China.
Well, the United States has reported a GDP growth of 6.4% in Q1 2021, and it's expected to spend $2 trillion on infrastructure. And this will translate into a major spike in demand for iron ore. Apart from the U.S., China has also reported a record of 18.3% growth in the first quarter of this year. Are these developments responsible for this 45% increase in the price that we see?
We would like to believe they are, or there are more prominent drivers at play here. For starters, we know that Chinese steel miners are front-loading demand in expectations that there will be a lot more, regulatory authorities will impose a lot more stricter measures on steel manufacturing, which will subsequently decrease the demand for iron ore. And this, of course, they are trying to front load so that they can have sufficient inventory for iron ore before that happens. Another thing we should look at is the fact that a significant portion of China's import of iron ore import in China is from Australia. Now, we have seen that there are deteriorating relationships between both countries. China last year imposed sanctions on certain imports from Australia, namely lobsters, as well as coal, but they haven't done the same for iron ore simply because they can't find a substitute yet for their imports from Australia. About 50% of their iron ore imports are from Australia, and they can't find a substitute for that bulk of supply from Australia. Brazil, which is the second largest producer and exporter of iron ore, simply can't meet the demand being required by China, and these are two reasons why in the medium term we are likely to see that the price for iron ore will continue to increase. Whether or not it's sustainable now, this price increase is left to be seen, and it's going to be largely dependent on whether China can curb its steel production in the near term.
Okay, so back here in Nigeria, the federal government announced a resuscitation of the Ajaokuta plant with a sum of 3 billion naira. And with this surge in the price of iron ore, does this make the Ajaokuta project viable? And if so, what is the estimated value of savings for the country?
Yes, so it is well known that the unofficial numbers for Nigeria's iron ore deposits are between 2 billion and 5 billion tons. It is also well documented that our imports for iron ore in 2019 were about $6.7 million, while our exports, about $6.7 million, while our imports were nearly 700 million, which is quite curious for a non-manufacturing economy. However, for the Ajaokuta plant, which the government said they would need about 3 billion naira to start its resuscitation, it is, I believe that a public-private partnership at the minimum should be looked at here, because the job of the government shouldn't be to embark on projects like this, but to give it to private individuals who would be a lot more efficient, because I believe that there is an opportunity here for Nigeria, considering the number of imports of iron ore that we have on a yearly basis.
All right, thank you so much, Seyi Omidiora, for sharing your thoughts with us this afternoon on iron ore, the new oil, according to Goldman Sachs. Well, moving on now, CDC Group, the UK government's development investment arm, is taking a step to help bridge what it estimates as funding gap of as much as $31 billion that Africa's agriculture and food industry faces each year. The 73-year-old institution is channeling $100 million to smallhold African farmers through export and trading company ETG, and is seeking other partners to help it to deploy more capital to the sector. Well, the African Development Bank is calling for proposals for projects enhancing the viability and sustainability of women entrepreneurs, enablers, women's business association, incubators, and cooperative that advance women's entrepreneurship can apply for funding for innovative projects for programs to bolster the skills of small and medium enterprises owned and run by women across Africa. Entrepreneurship enablers will include business associations and civil society organizations. And in South Africa, senior employees at a unit of South Africa's Public Investment Corps, PIC, have accused executives at the continent's biggest fund manager of causing a non-existential crisis after a series of scandals over the past few years. Staff at Isibaya Fund, which oversees unlisted assets at the $136 billion PIC, submitted a list of complaints, including failure to renew a mandate with the division's biggest client and allegations of general poor management. The letter, which dated May 7, shows that a 2016 agreement with the government employees pension fund, which manages South Africa's state worker retirement funds, is being allowed to expire. Consequently, the team of about 100 people won't be able to complete ongoing investments or embark on new ones until a new deal with the GEPF is negotiated. And that's the much we can take on this episode of Business Incorporated. Thank you so much for watching. I'm Ini John Mekwa.